Broadcast is now starting. All attendees are in listen-only mode.
All right, good afternoon, everybody. My name is Bobby Rains. I'm here for our Investors Observer Members Only Workshop. I hope everybody can see my screen. There should be a disclaimer on there now. It's pretty standard. All right, so let's get started. All right, so we're going to talk about what's going on at Investors Observer, do a little market update, and then the rest is member-driven content, questions, site demonstrations, etc. Thank you to those of you who sent in questions ahead of time. We will get to those after we do some of this other stuff. As always, you can prepare I can prepare slides ahead of time if you send your questions in ahead of time, so you get probably a slightly more coherent response if you do that, but we're always happy to take questions during the presentation as well. Please just put them in the box. If you have a question now, you can put it in the box now, and we'll get to things. I usually keep one eye on that as I'm going through, so if you have a question about something I'm saying in the moment, go ahead and throw your question in there. Otherwise, we'll get to them at the end. All right, so the big news at Investors Observer since the last time we talked 3 weeks ago is the Investors Observer Compare tool. It lets you compare up to 4 stocks, 3 if you're on your phone. Your phone is not as wide as your computer screen, so we just couldn't figure out a way to get 4 on there. You can add stocks from anywhere on the site. The tool will follow you around and let you to click through to see the full comparison. All right, so before we go too much further, that's not what I'm trying to do. Let's go to the website. All right, so not from here, but if we go to the stocks dashboard, you can see here we have this compare button that shows up here. It shows up here. It shows up in the My Portfolio feature. If you go to an individual stock page, you can see it here, so you can add that, and it pops up this little guy down at the bottom. If we go back to the screener, this guy's still here. You can minimize it to get it out of the way, and it goes over here. You can pop it back up if you want to see what's in there. And we can add some more stocks. And then once we hit 4, this button gets grayed out. It looks like that when it's grayed out in dark mode. All right, so once you get 4, or you can really do this with just 2 if you want. You can go to compare, and then you can see all the scores lined up. Look at the analyst forecasts and all the other data lined up side by side, or side by side by side by side, depending on how many you put in there. So that's that. We really like it. I think it probably helps take stock finding to the next step, in terms of you can go to the screener and find a stock, and then you can go to the page, and you can go back to the screener, find a stock, and go to the page. But this lets you kind of get all the stuff from the single stock pages. Once you get down to a relatively small number of stocks that you're looking at, you can compare them, side by side by side like that. All right, so that is the compare tool. Go back to here. There we go. All right, and now we're on to the market update. This is our pretty normal chart, 1 year of daily candles. Monday and today were pretty interesting. This did not actually capture the last hour or so of trading today, which makes this even uglier. The note I have to myself about this slide is that there's a question about whether or not we can stick around the 100-day moving average, and then also there has been some support in the past around 3280, which is hard to see on this chart, but we closed well below the 100-day and below 3280 also. So we'll see where it opens up tomorrow, but that's kind of interesting. All right, and then again, we didn't capture the last hour here, but the S&P 500 versus the S&P 500 equal weight. I mean, you see they both kind of topped out here. This is about October the 13th, which is a date that will come up later in the presentation. But yeah, and then have just been kind of sliding ever since. And then these last 2 days, really the cap weighted has fallen more, which means that essentially those big tech stocks that are, make up most of the S&P 500 have fallen more. Although it is interesting to see earlier today, this was relatively doing better. And this was relatively worse, so I'm not sure. It would be interesting to go back after the day is closed and redo this. But yeah, that's kind of something to keep an eye on as well. It seems like all the tech and a lot of the other high flyers have gone down this time just as much, if not more, than the stuff that just never really bounced from the first crash. And so this is one comparison that we kept. We did a bunch of these comparisons last time. You can still find that one on the site, but we did a bunch of these comparisons last time. And so this is just Disney and Netflix. Disney's in white. And it's very much a sort of, reopen versus stay at home trade. Like I know Disney Plus is a thing now, but Disney's making their money from, a huge amount from theme parks and people going to movie theaters and, things that involve leaving your house. Whereas Netflix is, pure play streaming at home. And so, yeah, you can see that Netflix didn't trade well after earnings, which is what this guy is about. But the last couple of days, it has done relatively better than Disney. And that's because we're still, coronavirus is still really where we're at in terms of what's making the market and the economy move around. All right, so another thing about Netflix, this is a chart from Netflix's earnings report. And I really kind of brought this to highlight the idea of something being pulled forward. So you can see back in the spring, so yeah, net ads is the way that Netflix describes new paid subscribers. And so you can see we started out on roughly a similar trajectory to the last several years, but then in the spring, Netflix just added a ton of subscribers. And we're, according to their projections, going to add more subscribers this year than any other year, but it's flat a little bit in the middle part of the year. And this is why that sort of, it wasn't really an earnings miss. Netflix trades mostly on this paid net ads number. That's the number that people compare to the analyst estimates in terms of determining whether it's a beat or a miss. And so what people say when they say something was pulled forward is all these people that signed up here didn't sign up in the second quarter, right? They all signed up in the first quarter. So the second and third quarters, well, I guess it's probably really more like the third quarter in particular, was relatively weak, right? Like this is much flatter, much fewer net ads from this June to September period than certainly the second quarter, but even most of the other quarters on this chart. But that's because a lot of people just signed up in March. And so things got pulled forward. So we've seen some other companies have sort of similar things where it seems like some sales got pulled forward. Kimberly-Clark is another one. They sell a lot of like toilet paper and hand sanitizer and the things that people were hoarding earlier in the year. And yeah, if you bought a year's worth of toilet paper in March, you probably still have you've used 7 months worth of toilet paper roughly since March. So you probably haven't bought it since then. Whirlpool is another one that had a really good second quarter. People started working at home. They decided they didn't like their washing machine as much, or maybe they didn't want to go to the laundromat, got a washing machine, things like that. People start cooking more, all of those things. And yeah, that leads to lower sales in the following quarter because a lot of this is essentially the replacement getting pulled forward in time, right? I would have bought a washing machine sometime this year, but I was home all day. I was doing more laundry. I decided I really hate my washing machine, that kind of thing. So that's what pulled forward means. And I would expect to see a few more of those kind of as this, as this earnings season in particular continues. All right, so what else is happening? The election is the big thing. back in 2016, markets also fell leading into the election. And then actually, it was kind of interesting, crashed super hard on election night. Futures hit limit down, and were stopped trading for volatility a couple of times. And then, if I remember correctly, I think the market actually opened higher, like gapped up and just rallied for the next several months. And so the initial wave of selling is obviously people being like, a thing I wasn't expecting is happening. I should not be holding these long equity positions, which is not entirely crazy unless you're going to change your mind the next morning. But yeah, I think really sort of either of the outcomes we're looking at could lead to some more volatility. Certainly, I think polls are starting to move the markets a little bit now. Biden winning the presidency seems to be sort of the market's base case. So I think big changes from that probably produce the most volatility. And I think you could see, certainly I think the sort of what goes up and down might change a little bit, right? If suddenly we decide that, Trump wins or something, you might see less interest in solar stocks and more interest in some other stocks, things like that. I think a huge sweep for the Democrats probably is, well, I guess that's the next couple of bullets. So yeah, a Trump win probably means a new stimulus bill the fastest, just because he's still going to be president and he's going to want to get the economy moving again as fast as possible. Whereas a Biden win, I think probably means no stimulus bill gets passed until after Inauguration Day, which is the 20th of January. They had months and months of negotiations leading up to the election and couldn't reach a deal. I don't really imagine Trump, after losing, is going to be super interested in making a deal with Nancy Pelosi. I just don't think it's going to happen. But I think a Biden win and higher levels of Democrats in government, right? So if they, take the Senate plus, +1 versus +4, +5, you probably get a bigger stimulus bill that way. But that money doesn't start rolling out into the economy until probably around February. So you're kind of looking at somebody I saw earlier today called it sort of a duration mismatch, right? So Trump wins, you get sort of a smaller stimulus probably sooner, whereas a big Biden and Democrat win, you probably get a bigger stimulus, but it's later. And so I think the market's having a really hard time figuring out like what is the what is the best outcome there, or what are the what do the various polls mean? But otherwise, yeah, still, like we talked about before with Disney and Netflix, still, very much sort of a virus-driven economy. Cases are rising again. Cold weather is likely to sort of push more spending online. That's good for bigger businesses, it turns out. Small local businesses have a much harder time, competing with online sales or even having any sort of online presence. And it's less good for smaller businesses or businesses that are just sort of moving online. So even big, publicly traded old line sort of retailers or whatever, if they're just launching their retail outlet, they may have a harder time competing than some other ones. The Fed meets next week in what is maybe the least anticipated Federal Reserve meeting of the last, 15 years. Yeah, I don't think they're going to make any changes. I think they're probably going to say that the economy needs more fiscal stimulus. All the sort of internals and things that the Fed has made tweaks to in terms of like bond buying programs, and all of those markets are functioning normally. So I don't anticipate them making any changes to those, but consumably they could come out and try to do some kind of state and local lending program, but they haven't shown any real interest in doing that prior to now, so I'm not sure why they would at this juncture. All right, so getting into some of our sort of rapid data. This chart is super interesting, perhaps only to me, but yeah, so the data lags a little bit, but on the 23rd, spending fell day over day, and then it's down over the prior week, and it's way up from the low. So things have pretty much leveled off. This spike here was Labor Day. Things have leveled off or sort of dribbled down. This hump here, I didn't pull out the charts because it didn't seem really necessary, but that hump is basically Prime Day and other, Amazon decides they're going to have a holiday devoted to buying things online, and every other online retailer says, yeah, we got to get on that too. That's what that is. If you dig into the data and look at the sort of card not present versus card present spending, card present spending went down over that period, and the entire spike plus some is card present, or card not present spending, which means people buying things online, any sort of transaction where the actual credit card isn't there. And yeah, so from the TSA, we're still broadly recovering, although the slope has really sort of flattened out here and started to go back down again since sometime in September. And the daily rate of change of the 7-day average has been negative for a while now, which again, right, this is just what we saw in the previous chart. The number of flyers is going down every day instead of going up every day. So anything above the zero line is a day where the number of flyers is going up. Anything below is a day where it's going down. All right, yeah, and that leads us to the questions. So again, if you have questions, put them in the box. Yeah, so we have a question about accessing audio, which makes me think you probably can't hear me. But if you have a laptop, you need to either turn on the laptop speakers or plug in a set of headphones or something like that. It's probably the best way to get the audio. This is recording. If you have any technical difficulties, this is being recorded. We'll send out the recording and post it on the website sometime tomorrow. All right, so getting into the questions. I think Steve sent this in. I don't know if it's the same Steve or not. So he had 2 questions. Pfizer has been leading the race to develop a COVID-19 vaccine, but the stock price has not reflected that. Today, the company announced disappointed, I think this question came in yesterday. PFE announced disappointing third quarter earnings. What effect would emergency approval of the vaccine have on the stock? I think generally it would go up in the short term. It's very good news about a product the company is developing. That's typically a recipe for a stock to go up. And it may, if PFE were to get an emergency approval or just to generally be approved first, I think that probably does something for market share. But the thing to remember about all of these big vaccine companies is Operation Warp Speed, as they're calling it, is pre-buying the vaccine. So back in July, the company said the first 100 million doses are going to the government, and Pfizer and BioNTech, I don't remember exactly how to say that company's name, BNTX is the ticker, are going to split 1.95 billion for those first 100 million doses. So the first 100 million doses are sold at what looks like $19.50 per share. So yeah, I mean, if your first 100 million doses are already sold at a price, getting them sooner probably means that you sell more in the out years, but I'm not sure exactly how to value that. I mean, if 2 vaccines get approved on the same day, or you get 2 in the same week even, I don't know, given how much the government has pre-bought, where you're talking about actually selling new vaccine is out a ways, and then you got to look at market share and things like that I don't think anybody has any idea how to really consider at this point. And the other thing is PFE did $12 billion in revenue in 2019. And so yeah, that almost $2 billion is big, but not like outsized huge. And yeah, at $19.50 per share, I haven't really researched this, but my guess is Pfizer typically comes to market with new products that they spent billions of dollars developing at a higher price point than $19.50. And the other thing is there's some opportunity cost loss here in terms of they were developing things. They diverted those resources into developing this vaccine. And now all of those other projects are behind. And so, yeah, all of those are the reasons why Pfizer hasn't just been killing it. And none of the big healthcare companies have been necessarily killing it. They're all up over the past year. But yeah, like once you sell your, first however many months worth of production, you're not going to get a big rally on every good news. Again, right, like market sentiment will shift for once vaccines start being approved. But I really have no idea how to tell you like this is how to trade that. And yeah, the other one was SRNE, which is Sorrento. I was doing fairly well until about a week ago, and then began a precipitous fall. They have a COVID test kit, and they're working on a vaccine. There hasn't been much news about the stock, what caused it to drop. So yeah, the chart is interesting. We'll look at it in a minute. But yeah, it's still up 345% over the last year. It was like more than 1,000% over the last year, a little while ago. But yeah, at some point that kind of change in valuation just doesn't reflect reality. There's a lot going on with the company. It was way up. There was a short seller report about how well their thing worked. They don't have the only COVID test, so I don't know how much market share they have. I mean, it's one thing to have a test. It's another thing to be able to sell the millions of them that are needed. So yeah, if you have a test and you can only make several 100,000 of them, you're doing better for having a test than not, but it's not necessarily going to, vastly change your, your company's outlook. And yeah, the short seller report casts some doubts on the efficacy of the test and some things like that as well. So it's hard to know exactly what's going on there. But let's go look at the website again because yeah, biotech started falling. Yeah, SRNE. I mentioned October the 13th earlier. SRNE started falling about that time. Most biotechs actually started falling about that time. And as a stock that's particularly volatile, you would maybe kind of expect it to go down more, right? So the 13th is about here. You'd kind of expect SRNE to go down more in a period when things are going down, especially when your more volatile issues are going down. But yeah, if you look at the last year, the stock was like $1.60 something a year ago. So to be at $7, like I said, it's still up 300 and something percent. But yeah, if you look at, let's look at the last month here. So the 13th is here. And then if we go to just the biotech ETF and look at the last month, there's the 13th again. So biotechs are down. There's no, I think, really any magic or anything like that. I think it's just biotechs are down because of, various reasons, because they were up by a lot. It doesn't seem like anybody's going to have a, virus killing vaccine super soon, etc. All right. All right, so Elena asked which stocks to buy for a short period of time during the pandemic. This is a good question. It's hard to say at this point in the pandemic in particular, other than to say that what's been working seems likely to continue working. So that's a lot of big technology, some smaller tech names that benefit from the stay-at-home economy. Do need to watch out sort of for that pulled forward effect, right? Like, we saw Netflix, Whirlpool, obviously. Zoom is a hard one to value. My guess is they've pulled forward a lot of new paid subscriptions. But they're also, right, have a lot more paid subscriptions than they had before, so I don't really know. It's hard to value a company that's as new as Zoom that has grown as rapidly as they have. That's a hard one to look at. Peloton is kind of interesting. They're relatively newer, but obviously benefit from the stay-at-home economy. Seem to be trying to release new products, and they have a treadmill or something now, as well as bikes at different price points. But yeah, generally, I think at this stage in the game, at least, the what's been working is likely to keep working, as far as I can tell. All right, so Jeff asked, could I go through the process of picking a stock candidate for a diagonal spread trade? What criteria should the underlying stock have? How do I determine the time frame, strike prices, etc.? Also touch on the short calls expiring in and out of the money and how this affects the trade. So I'll go through this on the website in a second, but the sort of bullet point version is I usually start with the option screener, actually. And that's because after years and years of doing this, starting with the stock and then trying to find the options piece is just more time consuming. There's a lot of stocks you might like that where the options don't work. So it works better for me, and just in terms of narrowing things down, it's quicker to find stocks where the options work and then decide if you like those stocks. Simple as that. Yeah. So yeah, some other things I look at in terms of the stock are I typically would prefer to avoid earnings. I usually check that box on the option screener that, the sold option should expire before earnings. We've held things through earnings before to mixed results. But yeah, I typically would prefer to avoid that if I can. Also would like to avoid dividends, but that's okay if the dividend is soon. And the reason for that is call options get assigned early if they're in the money on X dividend dates sometimes. The way to predict that is compare the extrinsic value of the option to the cash value of the dividend. If the cash value of the dividend is higher, your option will be assigned. And that's true 99% of the time. So yeah, if the dividend is fairly soon, and so the time value is going to remain relatively high over the dividend period, then it may be okay. But typically, I'd prefer just not to have to deal with it. And also, I sort of try to look for a stock that has a good story, which may sound like I'm right, but the reason for that is you want a stock that's been rising and there's some reason that it's likely to continue, right? Like these aren't like macroeconomic bets that are like, oh, there was a drought in the Midwest and so corn prices are going to be high, right? Like this isn't the kind of trade we're making here. They're pretty short term. They're usually a couple of weeks. So we're mostly looking at things the market has a reason to like and trying to avoid reasons the market might change its mind, right? Which is why you try to skip earnings. Earnings, other news events are things where markets can change their minds. It's one of the reasons we kind of don't put biotech stocks in these portfolios, because those drug trial announcements or things like that come out all the time and they're really hard to avoid. So just try to stay away is typically how we handle that. Let's get back to the website here. We'll go to the options screener. So we'll do bullish diagonal spreads. And typically what I do is I go through and I start with expiration date, and 60 days is pretty much the long end. I don't really want to do anything longer than that. Most of the time I want to do something shorter than that, but I'll put it at 60 so I make sure that the other things I do don't knock things out. Almost always with trades this short, you're going to be higher than the annualized return rate I put in, but this helps just cut the number down. I usually do 20 or 25, kind of depending. With the volatility as high as it is right now, 25 is probably reasonable. All right, so there's that. And then here we usually set 35 or 40 in terms of the net debit, just because I don't want to do a huge a huge debit on a spread. And then the overall score, usually I do about 55 or 60 here. Because I don't need something that's, a rocket ship. I just want something that's not going to fall off a cliff basically here. So, something that's a little bit above average, but, going sideways is totally fine for this kind of trades. And then I click this before earnings thing here. So that tries to find trades where the sold call will expire before earnings. Oh, hang on, I missed one somewhere. Key rating. I usually put in 4 keys. And so that'll get you the 4s and the 5s. And then what I like to do is come over here, sort it by key rating, so the 5s come to the top. These are typically trades that are short, have relatively high downside protection, and there's also typically a lot of options available, or at least the strike width is relatively low compared to the premium we get for selling the option, which means if we have to roll the call or somehow play defense on the position, it's just a lot easier. And then if you hold down the shift key after you've already sorted by one column, this really works best with the key rating column because it's a big group. Any of these columns with decimals, it doesn't work as well. But yeah, if you hold down the shift key and sort by overall score, you can bring the highest overall score to the top. That didn't seem to work. Well, that's just not going to work today for some reason. It says it's sorted, but it isn't. Huh. Okay, that's one for the IT team. Yeah, but still, so we've got the, well, let's just sort it by overall score altogether then. That works. All right, so yeah, so then I would start kind of going through them, right? You open it up, double check the earnings date and the ex-dividend date. Take a look at the chart. You know, a lot of times I like to see if there's a reasonable resistance point below, but not too far below the stock. So that's not terrible. You know, today's probably not a day I would be looking to open a lot of trades just because who knows what the open might look like tomorrow. But yeah, so Abbott Laboratories, Johnson & Johnson, those types of things seem okay. There's a lot of ETFs in here because it's earnings, basically, and so they tend to filter up when you try to filter out stuff for earnings. Pepsi, I don't love this sort of downtrend, especially because that was probably prompted by, well, that seems to date to about the 13th, so that's the same downtrend as the rest of the market. I might could talk myself into that, but I'd probably skip it. Yeah, so I mean that's basically what we're doing when we look for diagonal spreads, is just sort of that process and go through a bunch of stocks, and you either find one you love and then look through some more to make sure there's one you love more, or you don't find any you like sometimes, and you say, all right, well, today's not a day to make diagonal spread trades. So that's kind of how that works. And then yeah, expiring in and out of the money. Typically with these we don't let them expire. With the diagonal spreads in particular, it's not a problem if it expires, but yeah, what happens is if your short call expires, you sell the stock, which you didn't actually own. So you have a short position. You do own a long call that you can exercise to cover, or you can sell it and then buy the shares to cover. Some days it makes more sense to actually sell the option and buy the shares. But typically we just put in a closing order to close it. And if the option is in the money, it'll close. If it's out of the money, it'll maybe close if it's super close, but probably not. And yeah, if the option expires worthless, which means the short call expires out of the money, it means you get to keep the call you bought up front, sell a new call, or, you know, sometimes, you know, that call expires out of the money on Friday and the market's up on Monday, and so you can just sell the call you bought, and that's fine too. But you have plenty of options there in terms of how you want to handle that. All right. All right, so Tony asked, what is the best method to pare down an expanded portfolio, which has been allowed to grow to over 50 equities plus various options? I call it Tony's ETF. I understand most wealth managers suggest less than 20, but with our support and enjoyable invested time, that doesn't necessarily seem advantageous. He's an invasive growth investor attempting to maintain all equities, ETFs, and options with no bonds on a momentum strategy. So there's lots to consider here. One of the big reasons that conventional wisdom tends to limit the number of positions is transaction costs, right? I mean, if you have a relatively limited number of dollars, doing a lot of transactions when there's a fee per every transaction is just more expensive than doing a few transactions. Now, if you take away transaction fees, the dollar part of that has largely gone away, right? Now, you still, if you have 50 stocks, you still have to go sort of look at 50 stocks every day. So there's still some cost to having 50 stocks as opposed to 5. But the dollar amount of the transaction costs has gone away. And yeah, assuming you have a well-balanced portfolio somewhere else, you can, if you're trying to focus on aggressive growth and a momentum strategy, start by getting rid of things that seem like they're done running or going down. Maybe you have over time bought 50 stocks and none of them ever ran out of steam and started to roll over a little bit, but that's, seems unlikely. So that's the kind of thing I would look at. I mean, a good rule when sort of evaluating these positions is not, should I sell it here? Because that's a complicated question that involves a whole lot of, sort of psychology and like, well, I've had it for a long time or whatever. But a good rule is, would I buy this today? Right? Because I suppose there are 3 choices. But if you just think in terms of buy or sell, right? Well, if you already own the stock and you would buy it today, then keep owning it. If you already own the stock and you wouldn't buy it today, that's probably where you start to think about, no longer owning the stock, right? Like, if you wouldn't buy it today, why not? And that's probably a good reason to sell the stock also, right? Especially if, if you're looking for a long-term thing and you're trying to get, diversified, that's a different story. But especially in a case like this, where we're talking about like invasive growth and maintaining a momentum strategy, well, man, if you're not going to buy it today, like, why not? Right? Like, is there no momentum? Is it not an aggressive growth stock anymore? That's not a stock you want in your portfolio according to your strategy. If you're trying to have own the whole market and you know that some things are going to go down while other things that go up, that's a little bit of a different conversation. But, in this case, I would say that's probably a pretty good rule. And then the next thing I would say is look for overlaps, right? So do you have multiple ETFs that cover the same ground? You really don't need to own 2 S&P 500 funds. Right? Do you have Apple and then some other ETF? So like Apple and the S&P 500 ETF, Apple's 6% of SPY. It's 23% of XLK. So if you have some overlaps like that, that's another place you can start to look at cutting some things. And even in single stocks, you might not need to own 2 of certain things. So like MasterCard and Visa, they're different companies, right? Like there are reasons to buy MasterCard over Visa. But if you want to say, hey, these companies make money every time somebody swipes a card and they don't carry any credit risk, well, MasterCard and Visa are the same trade as far as that's concerned, right? JP Morgan and Bank of America, there's some slight differences in the business there, but it's not that big a difference. Union Pacific and CSX, there's a little bit of difference in terms of where those train lines run, but not a huge difference. I don't know that you need to own 2 of those. One sort of exception to this, you can't just look at industry and say like, oh, hey, these are in the same industry. I don't need both of them, because things like Qualcomm, Intel, and NVIDIA all are broadly in the like semiconductor chip making industry, but they make different chips. And so those are sort of a different sort of trade or play there, if you will. But those are the sort of things, if you're looking to cut down, those are the sort of things I would start to think about. Hang on a second. I thought I had one more question. Oh, yeah, there it is. Okay. All right, as a new trader with limited capital, is it best to trade stocks or options? This is from Damien. And it really sort of depends here. Some of the stuff we talked about with Tony applies here as well in terms of like, what's the rest of your financial situation, right? Like, are you otherwise financially secure? Is this money you might need soon? Is it money you'll definitely need at some point? You know, I mean, if this is the emergency fund, I would say neither. If this is money you might need fairly soon, yeah, you're going to want to keep that in something that's pretty liquid and pretty safe. If it's, you know, you're just starting a retirement account, again, you don't necessarily want to skew towards super safety at that point, but you probably don't want to see your account balance go to zero or swing super wildly. But if this is fun money, you know, and you're really, right, you're maybe been investing for a while, but you're new to trying to trade, options can get you a lot more bang for your buck. That does come with higher risks though, right? Yeah, you're going to find that everywhere. High risks come with high returns. Stocks are generally safer, but even then there's a big universe of stocks, right? I mean, some of the biotechs we talked about earlier that are up, you know, 300% this year. Some of those stocks are less than half of their stock price from a few months ago at the same time. So that's, you know, if you're just getting started and you're looking for safety, you may want to start with something like S&P 500 ETF, right? Like, it's low fees, it'll grow, it'll kick off probably somewhere around 2% in dividends a year. And that's safe and will grow. It's something you don't really even have to worry about too much before you start trying to jump into, like, you know, biotechs or tech stocks. But option strategies also vary widely in terms of risk and reward. The easiest ones that require the least amount of money are typically pretty high on that sort of risk reward scale. High risk, high return. Some of the other stuff that we do around here, right, covered calls, diagonal spreads in particular, can be a safer way to add options to your investing toolbox. Those are going to require, covered calls in particular, require you to buy 100 shares of a stock though. So that can be expensive. And diagonal spreads, a lot of times you have to be able to answer a few questions from your broker about, you know, they basically want you to make sure you understand what you're doing and aren't going to get yourself into some position where you get in trouble. So those things sort of require a little bit more experience than somebody who's maybe brand new to trading has. All right. Let's look through the rest of these questions here. All right, let's start here. There's one stock in here I don't actually know. So a sheet says, what do I think about Moderna, Guild not doing well, and also NWBO? It's going to be some kind of, yep, Northwest Biotherapeutics. All right, so this peaked and then fell after the 13th. I don't know exactly what the story with this one is. But yeah, Moderna and Gilead are both part of the same sell-off we talked about. No news, huh? Both the same sort of sell-off in terms of, you know, high-risk things that are falling. All three of these are in that biotech index that's tracked by this ETF that have been going down since the middle of October. The NWBO one looks a little bit different. I'm not super familiar with that stock. But yeah, there's a lot of sort of negative sentiment around the biotechs right now. And that's because, I bet even if we go Northwest Biotech, yeah, I mean, this stock is, I'm sure it's way down over the last couple of weeks, but it was at 35 cents a year ago, and now it's at $1.20. Yeah, I mean, sometimes the reason stocks go down for a while is because they went way up, right? The news hasn't necessarily changed. It's just people were like, whoa, hey, we bid this thing way up, way too fast. And yeah, all it takes is a significant decrease in buying interest, and things like that will start to fall. All right, so we have a question about Workhorse. So in particular, Tim says, what's your opinion on Workhorse or any similar stocks as we move further towards electric transportation? Yeah, Workhorse is another one of these. It's a little bit like, let's see, well, that's the 21st of September. There's the 12th of October. Yeah, Workhorse is like a lot of these, a lot of the biotechs in terms of it's way up over the past year. Yeah, 286 a year ago, and now it's at 1675. And they don't. So I think Workhorse has actually produced a few trucks, but they're still very small in terms of scale. And I think they have some contracts and things like that, but yeah, this is a very small company in terms of, I mean, it's not profitable. I don't have a full balance sheet here, but even being up this much over the past year, it's still a 2 billion market cap company in an industry where size is really sort of the king, right? Like, I mean, especially I think Workhorse is mostly in the fleet space. And if you're looking to make fleet transportation decisions, you want somebody who can deliver a lot of vehicles in a hurry. And also the thing you look at is, am I going to be the only person who's driving this truck, right? Because lifetime costs of replacement parts, if the company sells 10,000 or 10 million of the vehicle, is a huge difference, right? They sell 10 million of the vehicle, you can go buy parts from anybody anywhere. If they sell 10,000 of them, now you probably got to go to Workhorse every time you want a replacement part, and things like that. So it's hard to say. Workhorse may work out, it may not. But yeah, this sort of chart means it's not necessarily trading on fundamentals. I don't necessarily think the electric car thing is over in terms of the stocks running up and down, but in terms of being a sort of well-hyped thing where the stocks are going to run up and down, you're going to get them to run up and down. They're going to go up more when stocks are up, and they're going to go down more when stocks are down. So beta is a thing you can look at here. So beta of 2.5 means that this stock moves basically 2% for every 1% that the S&P 500 moves. Or well, in this case, 2.5% for every 1% the S&P 500 moves. So it's going to be a pretty volatile stock, right? It'll go up when things are going up, but it's going to go down when things are going down. And so I think you said somewhere else, you're a new swing trader. This can be the kind of thing that can be fun to trade in and out of. But yeah, sort of, be prepared that it's going to swing around a lot. All right, so the next question is also electric cars, Highline. And Gene says, what do I think about HYLN? They're developing an electric truck with help from natural gas and promising technology. Why has it been going down? Can't find a reasonable reason. Yeah, I mean, I feel like it's going to be pretty much the same reason. These charts are not that dissimilar. Can I compare two stocks on this chart? Yeah, here we go. I mean, in terms of things lining up, Highline and Workhorse kind of went up and then went down together. If we go back to the year, they're probably a little bit different. Yeah, it's basically different in terms of magnitude and not shape. So yeah, I mean, there's your answer, right? Like I couldn't tell you how to pick Highline over Workhorse. Highline has a market cap of $3 billion. It also has, well, so Highline just merged with a SPAC. And so this company has never actually released any sort of financial statement to the public. They don't have, yeah. This doesn't mean they reported 0 for earnings. It could be a positive number. It could be a negative number. We just don't know. We'll find out on the 5th of November. So yeah, it's real hard to tell for things like that, just because there isn't a ton of information. All right. What do we think Novavax is going to do in the near future? All these charts look the same. Yeah, I mean, this is another relatively small biotech company. Yeah, I mean, this thing was $3 a year ago. And I know they're in the vaccine space. Again, I mean, if I had to guess the next 2%, I'd say probably down, but you could hit that at 9:35 tomorrow. That's not really going out on a limb. Yeah, biotech analysts, yeah, analysis of biotech stocks requires a lot of in-depth research, right? You need to know exactly what it is the company's doing, right? Like what the drug they're developing will do, what the potential patient population is, what a potential price point is, all those sorts of things. And I don't have, I don't have the ability to do that. Certainly not in this sort of presentation. It does look like they have a coronavirus vaccine. I don't know that they're involved in the Operation Warp Speed thing, which, yeah, for whatever reason, may or may not mean their candidate is better. It may just mean that the government wasn't interested in pre-buying their vaccine. I don't know. But yeah, my general idea is there's a whole lot of biotech stocks that are way overvalued right now. I just don't really know which ones. I mean, a year ago, I think I probably could have told you that there's probably a lot of biotech stocks that are way undervalued, and I don't know which ones. This is basically the same thing, except these stocks have gone up by, I mean, yeah, good Lord, that's like 2,000% gain in the year, even with this decline. So yeah, I don't know. That seems kind of crazy to me. I see the analysts have higher price targets than that. But yeah, you never really know with these sorts of things, like what's gonna take off and win and what isn't. Because biotechnology is a thing that requires a lot of money, and it's very risky. All right, are there any other questions? That's the end of what we got ahead of time. As I think I mentioned earlier, this is being recorded. We will send out a recording. We'll get it posted on the website and send it out to everybody sometime tomorrow, usually in the morning. But yeah, we'll do that. The next workshop will be in 3 weeks. We will hopefully not still be talking about who won the election at that point. At the very least, we should know who won the election. So 3 weeks from today is, looks like about the 18th of November. So yeah, we'll be back for that. We'll send out invitations ahead of time, as we did this time. And we'll go ahead and set the workshop up so you can register for it tomorrow when we send out that link to see the recording of today's presentation. All right, so with that, it doesn't seem like there's any more questions coming in. I will go ahead and sign off here. Thank you all for coming. Thank you for subscribing to Investors Observer. Don't be afraid to get in touch with us between workshops. You can hit this help button and send us an email anytime. We try to get back to those pretty quickly. So yeah, thank you for coming. Look for that recording tomorrow, and I will talk to you in 3 weeks, if not before.